On April 27th, Jim Cramer said the rally in chip stocks was worrisome. Now, normally when Jim Cramer says something is worrisome, the contrarian move is to ignore him and go long. That's basically a meme at this point. But here's the thing. This time, the data behind what he's describing is so extreme, so historically unusual, that even the people who reflexively disagree with Cramer are looking at the same numbers and quietly clearing their throats. Because here's what just happened. The Philadelphia Semiconductor Index, the SOX, just went on an 18-day winning streak. 18 consecutive green days. That is the longest winning streak in the history of that index, which goes back to 1994. Not the longest in recent memory. Not the longest in a decade. The longest. Ever. And over those 18 days, the index climbed 47%. That's not a typo. 47% in less than 4 trading weeks. To put that in context, the average S&P 500 stock returns about 10% in an entire year. These chip stocks did 4.7 times that in less than a month. And when you zoom out to year-to-date, it gets worse. The SOX is up approximately 65% since January 1st. Intel, yes, the Intel that everyone was writing obituaries for 2 years ago, is up over 200% year-to-date. AMD is up more than 50%. ARM Holdings gained 41% in a single week before pulling back. Micron blew past an $800 billion market cap and is now up over 750% in the past year. 750%. That is not a typo either. So the mainstream explanation, the one you'll hear on CNBC and Bloomberg and in every hot take newsletter in your inbox, goes something like this. AI is consuming more chips than anyone predicted. Memory chip prices, DRAM and NAND flash, are up 25% and 18% respectively since late February. Supply is constrained. Demand is insane. The AI build-out is real, the CapEx cycle is in full swing, and the market is correctly pricing future earnings power. And here's where we need to be careful, because that explanation is not wrong. The fundamentals are genuinely strong. The AI chip cycle is real. But if the fundamentals story fully explained this rally, we wouldn't be sitting here with a valuation setup that Goldman Sachs says hasn't been this stretched since the year 2000. And we wouldn't be watching Michael Burry, the man who literally built his entire reputation on calling one of the biggest bubbles in financial history, file regulatory paperwork, showing he just purchased massive put options against the SachsX ETF, QQQ, Palantir, Nvidia, and Oracle, all expiring in January 2027. So what's actually happening? And more importantly, why is the speed and the structure of this rally different from a normal fundamental repricing? To answer that, you need to understand 3 things, and none of them are on CNBC. Let's start with the setup. Going into April, the market was in a deeply oversold, deeply hedged condition. The US-Iran war had started in late February. The S&P was down nearly 9% from its highs by the end of March. Hedge funds were selling at their fastest pace in years. Short exposure to macro ETFs like SPY and QQQ was at the highest level in years. The market was braced for something bad. And then on April 7th, Trump announced the ceasefire with Iran. And the markets ripped. Hard. The S&P closed up 2.5% the next day. The Nasdaq closed up almost 3%. Brent crude dropped 13.5%. WTI fell over 16%. It was one of the largest single-day moves in recent memory. And the mechanics behind that move, the short squeeze, the CTA momentum flip, the options dealer gamma, those mechanics lit a fuse. Because once the broader market started ripping, money started rotating hard into the most shorted, most under-owned sector of the market. And that sector was semiconductors. Because here's a piece of the story that rarely gets mentioned. While the AI chip narrative dominated 2023 and 2024, the first quarter of 2026 had been brutal for the sector. The Iran shock hit energy prices, raised inflation expectations, and pushed investors toward energy and defensives and away from high-multiple tech. By late March, chip stocks had significantly underperformed. Short interest in names like AMD, Intel, and Micron had quietly built up. The sector was hated, and when hated, heavily shorted sectors get a spark, especially a spark of the magnitude the April 7th ceasefire provided. The resulting move is never a proportional repricing, it's a squeeze. And then the squeeze gets turbocharged by everything that now runs on top of it. Which brings us to the second thing you need to understand, the CTA problem. Commodity Trading Advisors, CTAs, are systematic trading firms that run models. Their models are rules-based. They don't read earnings reports. They don't care about geopolitics. They follow trends. When the trend is down, the model says short. When the trend is up, the model says long. It's mechanical. And when major indices cross certain momentum triggers in early April, CTA models started flipping from short to long, not gradually, all at once. Because the same trigger levels hit across multiple models simultaneously. Goldman Sachs tracked this in real time and estimated CTAs needed to buy back roughly $86 billion of equities across just 5 trading sessions. To give you a sense of what that means, that's a top 5% buying speed print of all time. That's not allocation. That's forced mechanical buying compressing into a handful of days and landing disproportionately on the most momentum-driven sectors in the market. The sector with the most momentum in April was semiconductors. So now you've got a short squeeze in chip stocks and a systematic CTA rotation flooding capital into momentum names, all happening at the same time. And this creates a very specific feedback loop. Price goes up. Momentum signals strengthen. Models buy more. Price goes up more. More short sellers get margin called. They buy back their positions. Price goes up more. The passive funds, which are market cap weighted, watch semiconductor names grow as a share of the index and automatically increase their allocations. And suddenly what started as a ceasefire relief rally has turned into a sector going parabolic, for reasons that have less to do with AI demand and more to do with the structural plumbing of the modern market. And that brings us to the third thing, the options market. Same-day and short-dated expiration options now make up around 63% of all S&P trading. On peak days, over $2 trillion of notional options value changes hands in a single session. And every one of those options requires the dealer on the other side to hedge. When retail and institutional traders pile into calls on chip stocks, which they did in massive volume throughout April, dealers have to buy the underlying stocks to stay delta neutral. And the more the stocks rise, the more dealers have to buy. It's a reflexive loop. Price goes up, dealers buy, price goes up more, dealers buy more. Spot gamma flagged a negative gamma regime turning positive in April, which in plain English means the options market shifted from dampening volatility to amplifying it. And when that happens, moves that would normally be 1 times become 2 times or 3 times. Which is one more reason the Philadelphia Semiconductor Index posted the most extreme monthly performance since February 2000. Now here's the number that should genuinely give you pause. February 2000 was not a good comparable to aim for. In February 2000, the SOX posted its best month in history. It was an extraordinary, once-in-a-generation gain driven by the dot-com frenzy, irrational exuberance, and the same kind of mechanical momentum that was now playing out again in April 2026. And then in March 2000, the Nasdaq peaked. And then from March 2000 to October 2002, the Nasdaq fell 78%. Not 78% for the SOX specifically. 78% for the entire Nasdaq. April 2026 is now the second best month in the SOX's entire recorded history. The only month that beat it was the one that happened right before the dot-com collapse. Goldman Sachs analyst looked its current position relative to its 200-day moving average and said it was trading approximately 50% above that level. The last time it was this extended was the year 2000. Morgan Stanley flagged semiconductors as among the most overbought in history. And BTI analyst Jonathan Krinsky said in a note, and this is a direct reference, that the magnitude of the current markup in the semiconductor space not only resembles 1999, but in some ways is actually more extreme. More extreme than 1999. Let that sit for a second. Meanwhile, the Shiller CAPE ratio, the cyclically adjusted price-to-earnings ratio that smooths out earnings across a full decade, is now sitting at 40.1. The last time we saw a reading at that level was the peak of the dot-com bubble. And historically, when the CAPE ratio exceeds 35, forward 10-year real returns have tended towards 0 or negative. That's not a prediction. That's a historical pattern. It doesn't tell you when. It tells you how much risk you're absorbing for future growth that may already be priced in. And then there's Michael Burry. On May 8th, Burry published on Substack, feeling like the last months of the 1999-2000 bubble. And this wasn't just a comment. It was backed with money. Regulatory filings show Burry has purchased substantial put options on the SOXX ETF, QQ, Palantir, Nvidia, and Oracle, all expiring in January 2027, at strike prices well below current market levels. He is not just saying the market is frothy, he is betting with defined risk and a specific timeline that these names are coming down. Now, here's the honest context that you need to hear, because this channel doesn't do one-sided arguments. Burry has been right before in the most spectacular way possible. The 2008 call was real. The documentation is a movie, but he has also been early. And in markets, being early is functionally indistinguishable from being wrong. He was warning about Tesla and market fragility in 2021 and 2022 at various points with mixed results. The pattern with Burry tends to be correct on the diagnosis, less reliable on the timing. And on the other side of this debate is Paul Tudor Jones, a man whose track record and pedigree are not easily dismissed. Jones looked at the same 1999 parallel that Burry is making and reached a different conclusion. Jones thinks the rally could continue for another year or two before the analogy fully plays out. So you have two world-class investors looking at the same historical chart. One says we're in the last months. The other says there might be 12 more months of runway. That gap, that 1 year of disagreement between two people who are both probably right directionally, is worth an enormous amount of money. And nobody has a clean answer for it. But here's the question that cuts through both of their arguments. Because the fundamental debate between Burry and Jones about timing is a debate about when. The debate about whether is largely settled. Intel up 200%. Micron up 750% in a year. The SOX 60% above its 200-day moving average. The second best SOX month in history just happening to be the month before a new Fed chair takes over. The Shiller CAPE at 40.1. The Buffett indicator, total U.S. market cap to GDP, sitting at 219%, which Buffett himself once said was playing with fire when it crossed 200% back in 1999. These aren't opinions, these are measurements. And here's what connects April 2026 to every other episode of parabolic moves in financial history. It's not that the underlying thesis was wrong. In 1999, the internet was genuinely going to reshape civilization. It did. The promise was real. But the valuations priced in a version of the future that assumed perfect execution, no competition, no macro headwinds, and infinite growth at infinite multiples, and that version of the future doesn't exist. And when the gap between the priced-in future and the actual future becomes too wide, the repricing is brutal and fast, and it doesn't care how right the original thesis was. AI is real. Semiconductors are the backbone of the digital economy and will remain so for decades. But advanced micro devices is not worth the same percentage of its earnings as it was when it was a mid-tier also ran. ARM Holdings gaining 41% in a single week before giving it back is not a fundamental repricing. Micron being worth more than Ford, GM, Nike, and Starbucks combined does not reflect the calm, deliberate judgment of rational investors pricing in a 5-year DCF model. These are momentum events. And momentum events, by definition, reverse when the momentum ends. The question isn't whether the momentum ends, it's when. And right now, two other things are happening simultaneously that deserve your attention. Because the market doesn't exist in isolation. The Federal Reserve just had the most contentious FOMC meeting since the early 1990s. At the April 29th meeting, 4 policymakers dissented. The most dissents at a single meeting since November 1992. One wanted to cut rates. 3 others wanted to remove the easing bias from the statement entirely, signaling they're more worried about inflation than about growth. The committee is fractured. Jerome Powell, who just walked out of his final press conference as Fed chair, held rates at 3.5 to 3.75%, while saying the word uncertainty more times than anyone wanted to count. Kevin Warsh is now heading to a full Senate vote and will likely chair the June meeting. And the market currently has almost no rate cuts priced in for the rest of 2026. With some desks at JP Morgan now projecting the next move from the Fed is actually a hike in 2027. Let that sink in. Chip stocks just posted a parabank is split internally. The new Fed chair is untested. Oil is still at $106 a barrel. And Moody's AI-driven recession model is sitting at a 49% probability. Every time that model has crossed 50% historically, a recession followed within a year. The market is pricing in a soft landing. The bond market is pricing in prolonged higher rates. Gold is pricing in institutional distrust of the dollar. And the semiconductor sector is pricing in a world where AI demand grows exponentially forever with zero execution risk and zero competitive friction. These 4 things cannot all be right simultaneously. One of them is wrong, possibly more than one. And this is the part that makes the current moment genuinely unusual, not just overvalued, not just frothy, but structurally incoherent. Multiple asset classes are sending conflicting signals of a magnitude that doesn't typically resolve quietly. It resolves with a catalyst. And catalysts don't announce themselves. They arrive suddenly, they hit the leverage in the system, and the feedback loops that drove the rally up become the feedback loops that accelerate the decline. The same CTAs that flipped from $30 billion short to $86 billion long in 5 days. They will flip the other direction just as fast. The same options dealers who were forced to buy chip stocks as prices rose. When prices fall, they are forced to sell. The same passive funds that mechanically added chip stocks as their market caps grew. They mechanically sell when the index rebalances downward. The mechanism that created the rally is the same mechanism that will amplify whatever comes next. This is not necessarily imminent. Paul Tudor Jones might be right that there's another year of runway. Earnings estimates for the S&P 500 are rising, not falling. Consensus is now calling for 18.6% earnings growth in 26, up from the 15% estimate in January, generating real revenue for real companies. And markets, as Keynes pointed out, can remain irrational for longer than any rational person can stay solvent betting against them. But if you are sitting here watching Intel up 200%, and Micron up 750%, and the SOX posting the second best month in its history right after the best month was immediately followed by the dot-com crash. And your internal monologue is, this time is different. Ask yourself one question. What is the mechanism by which this time is actually different? Not the story, not the narrative, the actual mechanism. Because narratives are not mechanisms. And right now, the narrative is doing an enormous amount of heavy lifting. The last time a comparable narrative was doing this much work was 1999. And the last time the SOX had a month like April 2026 was February 2000. And 2 years after February 2000, the Nasdaq had lost 78%. So here's where I want to hear from you. Because there are 3 camps forming in real time. Camp 1, you think Michael Burry is right. The velocity of this rally is too extreme. The valuations are too detached from fundamentals. And the 1999 comparison is not poetic. It's a precise historical mirror. The gap closes through a correction, not a sideways grind. Comment Burry is right. Camp 2. You think Paul Tudor Jones is right. The AI cycle is genuinely different from the internet cycle because the revenue is real, the earnings are real, and there's still a year or 2 of momentum before any meaningful reversion. The analogy holds, but the timing is wrong. Comment Jones is right. Camp 3. You think this is a purely mechanical, structurally driven market where the question of right or wrong is almost irrelevant? The momentum, the CTA flows, the options dealer hedging, and the passive index feedback loops are running the show, and fundamental analysis is just the narrative people tell themselves after the fact to explain what the machines already decided. Comment the machines don't care. Because here's what's clear. The stock market we used to know, the one where the smartest analysts built the most accurate earnings models and the market rewarded the best fundamental work, that market is on life support right now. What's left is a system of reflexive feedback loops that take a real catalyst, amplify it beyond any fundamental justification, and then dress it up in whatever narrative happens to be available. In 1999, the narrative was the internet changes everything. In 2006, it was housing always goes up. In April 2026, it's AI is the most transformative technology in human history. All 3 narratives are to varying degrees true. None of them justified the price action at the time, and none of them made the eventual reversion any less painful for the people who were still holding when the music stopped. The chip stocks are up. The headlines are celebrating, the FOMO is real and visible, and somewhere on Substack, Michael Burry is watching a January 2027 option expiry and quietly waiting. History doesn't repeat, but it does rhyme. And right now, the rhyme scheme looks uncomfortably familiar.